For the next few minutes, we'll be exploring a professionally managed private lending strategy that protects capital first, generates predictable income second, and pursues long-term income through disciplined execution. Every aligned payment income opportunity is carefully evaluated, and it's structured and supported by multiple independent layers of downside protection. This allows our partners to invest with confidence and peace of mind. For those that I have not had the pleasure of meeting yet, my name is Andrew, and for more than 20 years, I've been involved in sourcing, structuring, repositioning, and monetizing residential real estate opportunities. My background combines real estate operations with engineering principles, and it's this unique perspective that has shaped the way we build investment structures with predictability and durability. That philosophy ultimately became the foundation of the WIN ecosystem. This opportunity exists today because of three powerful market forces that have been building for more than a decade. First, technology and remote working capabilities have allowed millions of Americans to move away from expensive areas into more affordable markets where we invest. Secondly, traditional home ownership has been more difficult to obtain. Because of stricter lending standards, millions of families who can afford monthly housing payments, they still cannot yet qualify for conventional financing. And third, investor appetite has changed. After years of market volatility and economic uncertainty, many investors are seeking predictable income and capital preservation rather than relying on appreciation or speculation alone. Now, individually, each of these trends creates an opportunity, but together, they create a unique environment where opportunity is no longer driven by a single market cycle. It's driven by a structural shift. We'll take a moment here to discuss the makeup of a structurally sound investment. Regardless of asset class, the strongest investments typically share four characteristics. First, there's a clearly defined contractual agreement. And second, there's always tangible collateral. And third is predictable income generation. And fourth, that's aligned incentives. And when operating according to plan, the result is a steady, long duration income stream. Every investment carries risk, but the safest investments have a well-designed system for identifying and managing risk before capital is deployed. Throughout my software systems engineering career, I learned an important principle, and that is critical systems are never designed around the assumption that nothing will fail. Instead, they are designed with redundancy so that if one of those components does fail, the system continues to operate. We effectively safeguard against systemic failure through six independent layers of downside protection. The first layer of protection is ownership of the underlying asset. Traditional lenders rely on a promise secured by a property. Our model allows investors to retain ownership of the property itself while experienced operators execute the business plan. What this means is that our partners are positioned to benefit from the income and the upside of the project while maintaining direct control of the underlying asset. This creates multiple layers of protection and flexibility that simply are not available in a conventional lending arrangement. The second layer is the recorded security instrument. This legal framework establishes the private lender's position within the capital stack. It creates clearly defined positions, rights, protections, and remedies, and is one of the most important forms of risk management available. The third layer is the contractual payment structure itself. Income is generated through legally binding payment agreements rather than relying primarily on speculative future outcomes. This shifts the emphasis away from prediction and towards performance. The fourth layer is one of the most unique aspects of the model, and that is behavioral alignment. Our structure is intentionally designed so that everyone benefits from the same successful outcome. For instance, the home buyer occupant benefits from future ownership, while the operator benefits from long-term payment performance. And meanwhile, the lender benefits from stable income generation. When incentives are aligned, performance improves and friction decreases. The fifth layer is the market itself. Not all real estate sectors respond equally to economic conditions, but workforce housing tends to remain resilient because it serves a necessity rather than a preference. Think about it. People may postpone vacations, they may delay luxury purchases, but they rarely stop needing a place to live. By focusing on affordable housing opportunities, we position the strategy within one of the most durable demand segments in the economy. The sixth layer is exit flexibility. The most common outcome is repayment through refinance or scheduled payoff. However, the structure is intentionally designed to avoid dependence upon any single exit path. Alternative strategies may include continued payment performance, negotiated resolutions, repayment restructuring, or even property disposition when it's appropriate. But the bottom line is this: options create resilience. So the more paths that are available to a successful outcome, well, the less dependence there is on any single future event. This strategy was not simply designed to generate returns, it was engineered to withstand adversity. One thing I've found true in over 20 years of real estate investing is that every investment looks good when everything goes according to plan. But the real question is, what happens when conditions become less favorable? And that's why we vet and stress test every opportunity before any investor capital is committed. The purpose is to understand how the structure will respond if and when adversity appears. So consider the market correction scenario where there is a sudden and unexpected downward shift in local property values. In this instance, the payments will still remain contractual and durable as they are established at origination, independent of any future fluctuation. Now, payment-based conditions are also included in our stress test analysis. Whether it's delays, interruptions, or economic downturns, we have payment default protocols in place to ensure that seamless continuation of income is still present for our investor partners. Any and all operational risks are also accounted for within the WIN execution plan. So, WIN provides oversight, servicing, administration, performance monitoring, and ongoing support throughout the entire investment lifecycle. This consistent involvement helps to ensure accountability, visibility, and disciplined execution from beginning to end. Even in the most unlikely event that there are multiple simultaneous failures, this investment structure maintains resiliency. Each protective layer exists independently of the others, so there is no single point of failure. So the takeaway is we do not evaluate opportunities based on how they perform under ideal conditions. Instead, we evaluate them based on how they withstand adverse conditions because protecting capital is not a reaction, it's a design principle. Now, traditional real estate investing often depends on variables that are outside of the investor's control. Things like market appreciation or future valuations, economic cycles, exit timing, even tenant turnover. But the aligned payment strategy approaches the opportunity differently. Rather than emphasizing appreciation, we prioritize payment performance. Rather than focusing on future value, we focus on current cash flow. And rather than relying solely on enforcement mechanisms, we create structures where participants benefit when others succeed. And it's that distinction that fundamentally changes the risk profile of the investment. Now, traditional investment structures are certainly a viable option for producing income, but they tend to break down when incentives become disconnected. Now, in our model, every participant benefits from successful performance. First, the homeowner benefits through a pathway to ownership, the operator benefits through long-term payment performance, and the private lending partner benefits through contractual income. So the result is a reinforced steel cable structure where each participant has a deeply intertwined interest in protecting the successful outcome. Now, behavioral alignment won't necessarily eliminate the risk entirely, but it can significantly improve performance consistency. And in our experience, aligned incentives are one of the most overlooked forms of risk management available. Let's examine a successfully completed real world scenario where my personal self directed retirement account was the private lender in this transaction. You can see the acquisition and renovation capital that was deployed was $80,000 in total. The collateralized asset value was $145,000. Now, the contractual lending rate was 12% per annum with a monthly income of $1,200 that was generated. So the total investor profit was approximately $51,000 that was paid to my self-directed retirement account by the time of payoff. What's important here is not the specific numbers, though. What matters is the structure. The investment generated contractual income supported by real estate collateral while creating successful outcomes for all parties involved. We don't necessarily view this strategy as a replacement for traditional investments. Instead, we view it as a complementary component within a diversified portfolio. The aligned payment strategy may serve as a retirement income component. It can also serve as a diversification vehicle outside of traditional equities. It may also be positioned as a cash flow oriented allocation that is designed to complement growth investments or an alternative fixed income allocation. It could also be used as a private credit allocation. So, what is the profile of a person that can benefit from an opportunity like this? Well, for starters, a person who is not looking for another job. Instead, they're looking for a simplified and efficient way to put their money to work and make it earn more money for them. They're typically business owners, corporate executives, medical professionals, engineers, even family office representatives, financial advisors, service providers. They range from sectors in technology, some are retired, services industry, small business, but these are individuals who have already solved the income problem and have not fully solved the passive cash flow problem. Their time is valuable and their expertise lies elsewhere, so they typically prefer investment opportunities where experienced operators handle all the execution while they reap the benefits. Now, let's walk through the process to examine the capital flow from a high level perspective. We'll start at the top with the private lender, where it all begins. Their role is intentionally simple. They provide capital. In return, they receive contractual interest payments backed by a tangible real estate asset. They're not managing properties, they're not finding deals, they're not handling contractors or homeowner relationships. Their capital works around the clock, 24/7, 365, while the Wealth Investors Network manages the execution. The capital then flows towards the operator, not to the operator. Here's what I mean. The operator never touches the capital. Instead, the capital is held in escrow by the closing attorney or title company until the closing is complete. Within our ecosystem, the operator is a real estate entrepreneur that has a proven high level of competence in managing real estate assets. So their responsibility is to acquire the asset, oversee any improvements, manage the home ownership relationship, and create value within the marketplace. In many ways, the operator serves as the bridge between the investment capital and the housing opportunity. Their success depends upon creating successful outcomes for both the lender and the homeowner, and they're directly accountable to the Wealth Investors Network for maintaining sound methodologies and ethical practices in order to stay in good standing status. But what this does is it creates a powerful alignment of interest that serves as the foundation for the rest of the transaction. Now, after the closing is complete and the property has been officially purchased, a deed is assigned to the operator with a legally binding mortgage note given to the private lender to solidify and protect their ownership interest in the asset. The next step in this process is to select the most fitting owner-occupant buyer to live in the home. At this point, the operator has made all necessary improvements to the property, they've marketed the property for sale, and they've secured an officially recorded purchase agreement with the new prospective homeowner. And after the terms of the agreement have been established between the operator and the new owner-occupant buyer, the seller finance payment collection process will begin. In this phase of the transaction, our professional servicing team collects all payments from the owner-occupant buyer and disperses them appropriately. This includes payments to any local municipalities, lien holders, and most of all, the private lender. So those payments will continue to be collected up until the time the loan is either paid in full or refinanced. And the collection activity records will be available, of course, to the private lender for both monthly and end-of-year processing. But throughout this entire process, WIN serves as the coordinating force behind the ecosystem. So we source the opportunities, we oversee the transaction structuring, we administer documentation and compliance, we support operational execution, and we help ensure that all participants remain aligned around a common objective. So the result is a streamlined investment experience that's designed to remove unnecessary complexity while maintaining transparency and accountability. Every investment strategy eventually comes down to one question: can the system repeatedly produce the outcome it promises? Our answer isn't based on theory, it's based on execution. Over the years, we've experienced a good deal of success. 22 million in capital deployed, 17 in capital returned. Average investor yield is high. But the thing that stands out the most is the historical default rate of less than 1%. Not because defaults never happen, but because our entire investment structure was engineered from the beginning to make successful outcomes the most likely outcome. That's why governance and oversight is so important, because it promotes predictability, and predictable, repeatable success is the direct byproduct of disciplined processes and systems. But understand, as impressive as some of these numbers may be, numbers only tell half of the story. Here's the other half of the story. Behind every investment is a family. Behind every renovated property, there's a neighborhood. And behind every successful real estate entrepreneur is someone who believed in them first. You see, our mission has never been to simply acquire real estate. Our mission is creating an investment ecosystem where everyone involved benefits. I want you to notice something important about that statement. None of our core objectives compete with one another. They're all interconnected. When the homeowners have pride of ownership, and the operators have meaningful equity, and the communities improve, and when investors receive consistent performance, everyone is motivated toward the exact same outcome. That is the core of our investment philosophy. Predictable income comes from behaviorally aligned structures because people naturally protect what benefits them. So instead of fighting human behavior, we've built an investment model that works because of it. Now, whether you're an individual investor, a business owner, a financial advisor looking for differentiated opportunities, or even a family office seeking disciplined alternative investments, our invitation is simple. Partner with a team whose incentives are fully aligned with yours, a team that measures success not by how many deals we complete, but by how consistently we protect capital and generate reliable income while strengthening the communities where we invest. Because when investment structures align human behavior with financial outcomes, everyone wins. If today's presentation resonates with your investment objectives, we'd welcome the opportunity to continue the discussion. Our next step is a private consultation where we can evaluate your investment objectives, your income goals, your risk tolerance, and your preferred investment structure. Together, we can determine whether the aligned payment income strategy is an appropriate fit within your broader investment portfolio, and we can also map out a plan to move you one step closer to your goals. Either way, I thank you for your time and your consideration, and I look forward to speaking with you in the very near future. All the best.